Hi and welcome to your Sunday Q&A marathon where we talk macro, try to make sense of markets that don't make any sense. But more importantly, answer your questions so we can become better investors. I'm your host, Steven Van Metre, and let's get right to your questions. I'm a big fan of your show and regularly tune in for each new video. Man, that's really awesome. Thank you. However, I have some questions regarding the relationship between foreign central banks and U.S. Treasury yields. Firstly, it is U.S. Treasuries are not exactly the same as U.S. dollars. No, they're not. One is a currency and the other is a debt. So isn't it possible that we can have global dollar liquidity crisis? And a global dollar liquidity crisis is simply a shortage of dollars in the international market or foreign market, while simultaneously high yields for U.S. Treasuries. No, I do not believe we can do that. My understanding is that U.S. Treasuries are future dollar obligations. Yes, however, they are commonly rolled over. So someone who owns a treasury at maturity just rolls it into the next issuance. While U.S. dollar is current currency need. And so, no, and the reason I don't think we could see that is because high interest rates, if interest rates were up, it refers to loose financial conditions, and that would mean there's lots of dollars out there, because how are dollars created? When people borrow money. So not the federal government, but when businesses and consumers go out and borrow money, dollars are created. So if we're in a high interest rate market where there's a shortage of dollars, we're going to go out and borrow? Probably not. So that's the challenge, is high interest rates would either presume there already was dollars already out, and there wouldn't be a dollar shortage, but to have them occur simultaneously doesn't make sense to me. Let's go on. In the video on June 17th, titled Fed Chair Powell's Big Mistake, from the 25th minute onward, you claim that central banks selling U.S. Treasuries would result in falling yields. That is correct. However, assuming that there are cascading defaults of dollar-denominated debt assets, wouldn't it be more plausible that nobody will have the dollar needed to actually purchase these treasuries? The large U.S. commercial banks will, because they're going to use their reserves to buy them, and then the Fed is going to effectively buy them off the large commercial banks for more reserves. So no, there's buyers out there. There's definitely buyers out there. Isn't the U.S. Treasury yield almost entirely dependent on the Fed money printing at this rate, completely overriding macro analysis? No, because the amount of government debt also helps determine where interest rates are. So the more government debt there is relative to the private economy, it crowds it out and causes interest rates to go down. There's also lending demand. So there's multiple facets to this. So you look at, is there enough lending demand to create money? Well, what have we been seeing in the lending arena? Other than corporations pulling their revolvers, we've seen lending growth slow and or contract. Depending on the credit card data, we've seen it contract on a year-over-year basis. Other lending, we're seeing it slow. So no, it's not entirely dependent on the Fed from a macro standpoint. Thank you for your videos. Just subscribed a few weeks ago. Man, sweet, thanks. And you're shattering my whole framework of macroeconomics. That is totally rad. Totally rad. Thanks for the education. You're welcome. My question stems from today's videos. When you said that, this is the Fed Chair Powell made a mistake video. When you said that when foreign central banks sell treasuries, that yields go down. This totally made my head spin. And you know, what's cool about what your comment is so far, is that when I was building my framework, I didn't have me to help. You have me so you can at least get some of what my process was. So when I say try to make sense of markets that don't make any sense, there's a reason, because there was literally one point in the middle of the night that I literally told myself that I had to accept that things were not the way I thought they were. And it was only at that point that I started to understand things. So yes, they don't make any sense. You said, if there are too few dollars in the global economy, foreign central banks need some dollars because they're getting demand from foreign companies because they have dollar-denominated loans. So I'm assuming that these foreign companies liquidate assets or raise capital denominated in their local currency one way or the other. And then ultimately they exchange them for dollars with their central bank, which in turn sells the treasuries to obtain more dollars. Yeah, Perfect. I guess I'm a little confused. Do you mean they say that their selling of treasuries makes yields go down? Or that the whole environment is deflationary and hence their selling of treasuries is a symptom of a deflationary market which will drag yields lower? I wasn't sure how to phrase this question, but I guess I had a hard time understanding your explanation because I'm very new to this way of thinking. Thank you so much for your time and look forward to your next video. And you're going to look more forward to this one because I'm answering your question. Okay, so in the dollar liquidity cycle, if we took the circle and made it a linear path, what's the end one? Maybe it's this way for you. I'm terrible at this. What's the end part? Where the foreign central bank gets it. So by the time there is inflation or deflation, the last person in the chain to know is the foreign central bank. So they either have to go out and buy treasury securities because now they have too many dollars, or they have to sell them because they have a demand of, they need dollars to meet demand. So let's look at your question. So in a deflationary environment, what happens to interest rates in general? They go down. So the fact that the foreign central bank is selling them does not necessarily mean that interest rates go up. That is not true. In fact, if you go look at a chart, and I think we did, you actually will see that in most cases when foreign central banks are selling, and I said most, not all, yields go down. It's a deflationary environment. So that tells us there's a counterparty that wants those bonds and realizes that the foreign central bank needs to sell them. Does that help? I hope. Let's see. So yes, them selling their treasuries is a symptom of a deflationary market. That is correct. I am your subscriber from Australia. Sweet. I love it. Man, we're going worldwide. Thank you for your thoroughness. It's been helpful for a novice like myself understanding the macro. You're very welcome. I really benefited from your latest YouTube episode on Powell's Big Mistake. You'll notice I got a lot of questions on this video. I thought I would. Here's my question on global dollar liquidity and the relationship between Treasury yield and foreign central banks doing with U.S. Treasuries. What about the swap lines that the Fed has opened up to other central banks? Now, let me explain for those who don't know what the swap line is. So the Fed always believes a dollar shortage is a short-term issue. They don't see the bigger picture, okay? That's very important to understand. So they hear that, hey, central bank, say the Bank of Japan's like, hey, we're short dollars. And the Fed's like, all right, well, why don't we take some of your currency and we'll swap it with dollars. So how about some yen for some dollars? And by the way, we'll make it a 7-day or 14-day loan. And at the end of the loan, we'll give your currency back and you give ours back, and we make a little bit of interest on the deal. So that's what a swap line is. My understanding is that the swap lines are there to stop foreign central banks from selling off treasuries. Yes, I would completely agree with that, because look, how else is a foreign central bank going to get dollars? They have only one mechanism to get them: sell U.S. Treasuries. So the Fed really doesn't want the market flooded with them, and they weren't able to react fast enough, as we obviously learned in March. So what did they do? They simply went out and said, hey, we'll start running some swap lines. And that does work. Now, is it a permanent solution? Nah, it's a Band-Aid over a bigger wound. But do I think they will work? In the short term, they do work. In the long term, the swap lines do not fix the problem. And the reason they don't is because the swap lines don't create dollars, right? They're just a temporary patch. So let's say at the end of that 7-day loan, what does the foreign central bank need to do? They either need to roll the loan, which guess what? It's going to cost them a little bit of interest, or they need to get the dollars. Well, if world dollar liquidity isn't being restored in 7 days or 14 days or whatever the term of the loan is, not going to work. And that's why it's a short-term Band-Aid. Thanks again. I hope I have articulate my question well. I hope I articulated my answer well and that we're on the same page. Another great lesson. Thanks. Where on your world dollar liquidity scheme, scheme, that's an interesting word for that, comes the euro dollar system in play, if at all? Effectively, it is the euro dollar system. There have been comparisons to Jeff Snyder's research on the euro dollar system, which arguably I have no clue of half of what he says. I mean, I get the guy's super smart, knows it inside and out. World dollar liquidity is just the easy to digest version of what he speaks of. So effectively, we're talking the same language. seems to be big and out of reach of the Fed. It is out of the reach of the Fed. So what the question is referring to is dollars in the foreign market. Yes, the Fed doesn't have any control over them. They have none. That's the problem. The dollar short, so the shortage, I think he's referring to the shortage of dollars in the world system contrasts with a euro US dollar that is up. Question mark. I don't know. I don't really do anything with currencies beyond the dollar index, so I don't know. Also, treasury yields are rather low due to QE, and therefore the dollar should be higher. I agree the dollar should be higher, and I believe we do see a blow off top in the dollar and more during the coming stock market crash. Here we go. The dollar goes up to its peak. Yeah, I totally agree with that. And I meant to have a chart ready, and I thought I had a different question coming up first. So let me go prep this real fast so we can see, and then we'll switch over to, and we can go to the max on this and see here is 3.9 of 09, the peak of the dollar crisis at the time. There's the bottom of the equity market. There was another spike, a double top in the dollar. Equity started to melt down a little bit, and then the dollar finally eased and the equity market went. So there you go, top and bottom. There's another good thing to look at when the time comes in terms of finding an equity bottom. Great question. All right, next. Whoops, that's not where we wanted to go. Okay. First of all, great many thanks for answering my previous question, Steven. Hey, you're welcome. I really do enjoy hearing your frequent updates on the weird macro situation out there. Thank you for that. Hey, we're just here trying to make sense of something that you can't make sense of. You're welcome. Admittedly, you completely derailed my confidence that I so understand how the bond market works when you said that yields go down after foreign banks sell U.S. Treasury securities. I totally knew that was going to change people's perspective, or at least start to get you to think, because, you know, really what macro is and what's fun about macro, if you're a thinker or want to be a deeper thinker, go play in the macro space, because what you think it is not what it is. And it's just multiple layers. It's like trying to think in the fourth dimension. I mean, there's just so many pieces to this. It gets really interesting and it's fun. So I'm glad I'm making you think, because that's good. Now, please correct me if this is wrong. You explained that in the healthy world dollar liquidity cycle, foreign banks accumulate dollars. That is inflationary. Correct. So they get rid of those excess dollars by purchasing U.S. Treasury. We'll add Treasury securities in here, not just so if there's any confusion, not stocks, but Treasury securities. On the contrary, this would imply that if the foreign banks are short dollars, it indicates that world dollar liquidity cycle is shrinking. You got it. That is perfect. i.e. there is not enough dollars coming from U.S. consumers purchasing foreign goods. Perfect. And that it is a sign of deflation. Foreign central banks have to sell U.S. Treasury securities to compensate their shortage of dollars, right? Yes. But the part I do not understand is how foreign banks, I'm only laughing because I read this before, so I think I know which question this is, and I'm going to change your thinking a little bit here. Part I do not understand is how foreign banks now throwing their U.S. Treasury securities out of their balance sheets onto the market, i.e. selling, would drive the U.S. Treasury securities yields down. More sellers means more U.S. Treasury securities on the market would drive their price down and yields up. Okay. So you ready for this? Here's the deal. Your assumption is there's no buying demand on the other side of that transaction. Oh, didn't see that coming, did you? So what if there was what if there were buyers on the other side of that equation and there was demand for those Treasury securities and they bought them at either market value or maybe above market value because they really, really wanted them? So why does, I come back to this, well, if I put my house up for sale, does it go down in value? Well, what if I put my house up for sale and two of my other neighbors do? Does it mean the values in my neighborhood goes down? What if 10 people in my neighborhood put their houses up for sale? Do the prices all go down? No, not necessarily. They could if there's no demand, but what if there is demand? What if there's 50 people that want to move in my neighborhood? Well, then the prices might go up. So the question is there a counterparty to the selling? And there is. Who is it? I'll tell you who indirectly it is. It's the Fed via the large commercial banks. So there is a demand to get these. So it does not necessarily mean that yields go up. So yes, you can have selling and bond prices go up and treasury yields go down. Pretty cool, huh? Hopefully that helps. Another thing I do not understand is the difference between the following situations. If I go to get a loan, purchase a German automobile, it boosts the world all liquidity and is inflationary. Correct. If a company in Detroit needs cash to buy material components from Germany, therefore issues corporate bonds, and we'll just say not directly, but in an indirect method, the Fed comes around and buys them, the company can accomplish their material purchase. How is that different? It's not. Regardless of those corporate bonds end up in the trash bin, the money has been spent in the world all liquidity cycle. To me, it would seem inflationary. Yeah, you're correct. I don't think the Fed is buying corporate bonds to fix the world all liquidity cycle. As I covered in Saturday's video, I think they're doing it to take the pressure off the corporate bond market. But using your questions as they are, you got it. That would be. It would be. But I think there's a limit of how far the Fed's going to push us, because technically it is money printing. I mean, it is like, if there's black, white, and gray, I mean, that is just smack in the middle of the gray, because you can kind of almost go either way, but you can't go 100% either side. So yeah, you've got it exactly right. I'm sorry, I must be missing the point big time. Just don't know where. Thanks a lot if you have time to elaborate in this. If not, thanks anyways. I think you got it. But I don't think the Fed's buying enough bonds. And I don't think the bonds they're buying are going to buy stuff, saying in your question, in Germany. What are they doing? They're going to fix the negative cash flow the corporations have. That's where it's going. So it's the money's going to die. And now it would be different if, in your scenario, if it was going to say, hey, buy some parts to finish the assembly of those German vehicles, say in the U.S. Say there's an assembling plant here. Yeah, that would be great. But that, in this case, it doesn't. What we're doing right now isn't going to fix the problem. Does that help? I hope that makes sense. Hi, Steve. Got a quick question for you. Your next Q&A. Is it plausible that banks could be lending against their QE cash to other banks, and then those banks could put that money into stocks? Thanks, and keep up the awesome videos. The answer is no. Here's yet another question for you. I watched your latest show, The Fed Chair Powell's Big Mistake, with great interest. Awesome. I had a lot of fun with that episode. Throughout the previous shows, you've demonstrated very clearly that I can't enunciate. The QE is deflationary and should not in itself cause stock prices to go up. I was thus led to believe the QE did mostly nothing. It was a fundamental mistake. It does mostly nothing. Let's just put it this way. What everyone thinks it does, it really doesn't do. It does do something, as you will get to in your question. But just for those of you that are kind of new to this, QE does nothing. It largely does nothing. It doesn't do all the stuff that it's claimed to do. From this latest video, I'm starting to reconsider and greatly appreciate if you could confirm or infirm my current understanding. Currently, the Fed has two real tools to influence the economy: the federal funds rate and quantitative easing. That is correct. Since negative federal funds rate don't seem to be in the plans, I agree, that leaves only QE. The Fed's goal is to help relaunch the economy, and the only way they could possibly do this is by pushing lending rates lower to incite spending. You got it perfectly. The lower lending rates in themselves are not inflationary unless they cause spending to ramp up. This might possibly result in higher lending rates and inflation down the line if the recovery materializes, which is not guaranteed. You got it. Driving lending rates lower should be expected to cause short-term pain to investors, lower equity prices, higher bond prices, since that's the only path to possibly getting the machine running again. 2 thumbs up on that, man. You got it. You got it. 1, therefore, is the Fed's choice to even do QE appropriate in the perspective of stimulating the general economy, since you referred to Powell making a mistake in slowing QE? All right, here's the deal. Let's just pretend we're Fed Chair Powell, and we are essentially the most powerful man in the world, because he can create and destroy the global economy. He can destroy it a lot. He can't really, he can sort of fix it, but he can't really. He can only ease, or he could tighten monetary policy and just destroy things. All right? We assume that he likes being the Fed chair, even though it doesn't seem to be the greatest job in the world right now, and that he'd like to continue being the Fed chair in the future. Now, let's say that he does nothing, right? Let's say the economy is melting down and he just sits back in his big Fed chair seat and does nothing. One, he's going to get fired. Number two, do you think his legacy of being the Fed chair is going to look real good? No, he's going to be on every magazine and every textbook, every newspaper about he's the biggest idiot that ever sat in the chair of the Federal Reserve as the chairman. I don't want to do that. That's not how he wants to go down. No, he's going to go Bernanke style. He's going to throw everything at it that he possibly can, because in the end, if the economy crashes, he can say, hey, look, I did everything I could. It's not my fault the government ran up so much debt. It's not my fault you consumers ran up so much debt. It's not my fault you speculated on stocks and houses and others. I didn't do that. But he doesn't want to be that guy. He wants to be the guy who said, look, I didn't do that. And instead, he wants to be on the magazine cover that said, the savior of the economy, flooded with trillions of dollars of liquidity and saved us. That's what he wants. Because the alternate is bad. And in the end, one version, the economy crashes and he looks like an idiot. The other version, the economy crashes and he can look like a hero. What would you do? Look, it's simple. It's really simple, right? Both outcomes suck, but one makes you look better. I wonder which one he's going to pick. Is the issue with QE simply that most people are misinterpreting its effects and goals, so it's driving a speculative bubble? Yes. People do not realize that QE only causes interest rates to go down. That's what they do. And suppresses interest rates. If it doesn't cause them to go down, it acts as a suppressant. As a Powell's mistake, we could see the Fed slowing down a QE analogous to pulling the Band-Aid very slowly, thus causing more damage. Would we then expect the equity's eventual downside to become even greater due to this decision? Yeah, see, the problem here is, what is the solution to the world liquidity cycle? We need to get interest rates down low enough to get people to borrow and spend. Now, today we just found out through TransUnion that 106 million loans are in forbearance or some form of payment delinquency that people aren't paying. So we need lower rates, but we need lower rates and we need the people to go borrow and spend. So the longer that Powell keeps interest rates up enough, I mean, not that they're high, but where they're not causing people to go out and borrow and spend, the worse the problem gets, the longer it goes, right? If I'm hemorrhaging from sickness or a wound, right, and the longer I don't go to the hospital, it's not like, oh man, Steve, great thing you didn't come to the hospital for a week because, it gets better. No, it's like, you idiot. Get down there and patch that thing up, get some antibiotics or whatever it needs to get done, because it only gets worse the longer you wait. So his problem is he felt like he couldn't do any more without looking like he was blowing a big bubble that he's blowing anyways. Because people believe that it does something it doesn't do, so they bought stocks in hopes that he can indefinitely keep them up. He can't. He has no power to do that. Once again, thank you so much for sharing your research and knowledge. Look, if the Fed could do that, we'd never have a down day in the market. We'd never have a recession. They'd just keep, we're price target for the S&P this year is 12%, and we're going to do enough easing equivalent. That would be quantitative easing, because if we're going to do X amount of easing to make stock prices go up X percent or Y percent. Can't. Well, maybe it's, you get the point. Okay, ever onward. Thanks for all your effort in making these informative videos. You're welcome. Question for the show. I know you've tried to answer about the relationship between the dollar and bond yields. You explained the historical inverse relationship, but I'm still having trouble with the why. Okay, it's not perfectly inverse, and that was the actual chart that I had ready. So let me let's go look at it. So it's not. It is. I want to refer to it as a relationship, not an inverse, because it is not inverse, but it is a relationship. So here is 10-year treasury yields. Here's the dollar, and you can see generally when the dollar is rising. Here the dollar is this one. When the dollar is falling, yields are rising. And you can see when the dollar. Now my brain is backwards. When the dollar is rising, yields are falling, and dollar kind of rising, yields falling. So why is that? It's simple, because When interest rates go up, it is a sign of easy financial conditions, and during easy financial conditions, you would expect to be bearish on the dollar. And when interest rates are high or low, when they're down, that is a symptom of tight financial conditions, so you would expect the currency to be strong. That is what you would expect. It is, like I said, it's not perfect. Whoops, I'm trying to get back to where, here we go. But it's close, so it's a relationship. Is this a direct relationship with the dollar index and global bond purchase and selling, or does the global dollar shortage have nothing to do with the lack of loan creation at the commercial bank level driving yields down? It's multiple things. So we have the world dollar liquidity shortage. We have the lack of lending demand. It's multiple things. So that's the fun thing about macro. It's not just one thing. So if you're fixated on like, okay, I'm pretty sure this is why this is, no, there's 2 or 3 more things. You got to look at the big picture. That's what's fun about it. It stretches your mind. Thus, the dollar going up due to lack of foreign dollar liquidity and as a result of yields going down due to lack of consumer loans, thus creating a lack of dollars in the cycle, basically is one indirectly affecting the other. Yes. I would look at it as they're magnifying the situation. If we actually had some lending growth, it would help, but we don't. And also, we have a dollar shortage, so the two make things worse. That is why I believe we see a blow-off bullish move in the dollar and a big surge down in yields, and that kind of blows the whole system apart. That's why I believe that, because we have multiple problems going on here. And the coronavirus didn't help it. It didn't help it at all. I mean, it made it a lot worse. It didn't fix it. We had a dollar liquidity problem and we had tight financial conditions, and now we have even a worse dollar liquidity problem because there's no trade. Our trade's down, foreign travel's down. So look, dollars just got to get to foreign countries. Even if there's a scam emails where you send someone money, it's still the same thing. It still works. And now we have lower interest rates because people are out of work. They're not able to borrow. They're not able to get loans. The two are causing some big problems. All right, by the way, Coke or Pepsi, that's an easy answer. My wife likes Pepsi. But look, what sort of self-respecting gentleman, which of course you would say is not a self-respecting gentleman if he orders an alcoholic beverage mixed with soda. However, I do enjoy that. It's a nice way to drink, but not all times. So again, no somewhat self-respecting gentleman could walk up to a bar and ask the bartender for a rum or Jack and Pepsi. It doesn't seem right. So, Coke, absolutely. All right, let's see. We've got time for a couple more. You stated a few times that the Fed does not have the power to fix world dollar liquidity issue. Can you please go into more detail? Naively, the Fed can print an infinite amount of dollars. Doesn't that mean that they can fix world dollar liquidity, or is there an implicit upper limit to the amount of printing they can do? All right, so the Fed has two tools. They can raise rates and lower rates. Now, what happens when you raise interest rates? What happens to lending demand? It goes down, right? I mean, hey, mortgages are 10%. You going to go buy a house? Nope. Simple. So what they do is they constrict credit. They constrict the creation of dollars by raising interest rates. Now, how come the Fed can't create dollars? Well, they don't have the tools to create dollars. They can only lower interest rates. But look, you can lead a lender to the bank, but you can't make them borrow. So my wife has to, well, in your Wednesday video, I think it was Wednesday, you said, well, there's an 11-week high in mortgage applications. She goes, are these closed applications or just applications? They're just applications. So she says, so half of them could be denied. Yes, they could. She goes, do we ever know that? No, we don't. So the Fed can lower interest rates, but they can't make you and I go borrow money and spend on foreign produced goods and services. They can't do that. So the Fed can't create money. That's why they can't fix it. Now, is there a limit to what the Fed can do? Yes. So let's say the federal funds rate stays at zero where it is now. And the Fed says, look, we got to do so much quantitative easing, it's going to make your head spin twice. Well, how much quantitative easing can they do? Well, they could buy, in theory, every last Treasury bill, note, and bond, and then they'd be done. That's it. Now, of course, would the federal government be borrowing more and spending it? Yes, but there is a limit. They can only buy the treasuries that are available. And then once they're gone and on the Fed balance sheet, that's it. So hope that makes sense. All right. Love your videos. Keep up the great work. I will. Thank you. Keep watching, and we'll keep going. Also, I'm looking forward to hearing more about the Vic story as well, but I agree that it can be saved as a celebratory one once the macro thesis plays out. And, this is a great video or question to end on, and I got some more, but we'll save them for next week, is the Vic story is going to change things. And it's not a it's not a brag video, because if it was a brag video, I would do it already. I mean, it's not what it is. As I mentioned in a couple other videos, it's a story about macro and a story about a difficult time in my family due to my wife's health conditions. It's just an impressive amount of risk tolerance and pain of someone who had absolute conviction of their research and was willing to bet it all and go all in. Because when you really are convicted about something, right, you go all in. And I did. And it was stupid. And you'll see when the story does eventually come out, you'll see, well, like, man, that was really dumb. And then you get to the end, you're like, wow, well, it didn't end dumb. And it didn't, because I was very convicted about my research and my macro thesis. And that was what makes it a great story, because there's lots of little pieces along the way that you just won't see coming, and it makes it fun. Now, the problem is it's going to change things. And this is what I'm struggling with right now. It will actually change things. Like I said, there's a handful of people that know about this. One is my publicist. You say, you have a publicist? Yeah. I'm in business and advertise. I need someone who knows more than I do. She says, absolutely, the story needs to go out someday. A friend of mine is also my psychologist. Brilliant man. Great close friend of mine. And arguably, if it wasn't for him, my wife and I, he didn't put us together, but we would actually probably would have met. So we owe him a huge debt for all the things he helped with. And I think even as a professional, I mean, it's good to have, some help for your brain, every once in a while. It's good to have that. And he, on the other hand, calls me the other day and says, hey, have you spent the money yet? I was like, no, I haven't spent any of it. And he goes, man, when you need to get a car. Now, there's a sub-story to this about my son who works at the local Porsche, Audi, Volkswagen dealership. I love electric cars, and I have happened to drive a very expensive electric car sold by one of those three manufacturers. You will go figure it out. It's not that hard. Then this story happens. Boy finds out. Now suddenly when I walk into the dealership, it's whatever you wanted to drive, sir. And I got to drive it again. Now I asked the boy, how is it I got a second shot at this thing when I'm not even remotely close to doing anything with this? He goes, oh, you have an allocation to buy one. I said, what? He goes, yeah, I put you on the list to get a build from the factory so you could get the one you want. Oh. And he goes, and if you have an allocation, you get to drive it again. Okay. I still have an allocation for January. I just got informed that I got bumped to January. So you can go figure out what this is. And my buddy, so he called me and he goes, man, I want to go for a ride. Did you get the car? I said, no, I haven't got the car. And he goes, so what did you do with the money? I said, I made more with it. He goes, of course that's what you would do. Of course. I'm like, I'm still convicted about my research. He says, of course, that's what you would do. Now, it's going to change some things. It's not going to change me. It's not going to change the show. It's going to change the channel. And I really like all of you. And I'm really enjoying what we got going on here. But it's going to change things. And I want to make sure it doesn't change what we have now. And I don't know how to do that yet. And I don't know when I'll be ready, but I can assure you, you will be the first to know when I'm ready, because I'm going to have to write out the story. I'm going to actually edit a video for a change, and you will get to find out. You'll be the first, because I am going to use it as a local marketing campaign too. I may even use it beyond that. But it will change things. It will change the channel. The question is, are you ready for it? I'm not yet, but I'm working on getting ready. The question is, will you be here? I don't know. I think you will. Everyone loves a story, but it will change things. Anyways, I'll see you soon on Monday. Thanks for watching. I'm Steve Van Metre. The content of this video is provided as education information only. It is not intended to provide investment advice. This video is not to be construed as a recommendation or solicitation by or selling security, financial product, instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.